Welcome back, friends. Let's talk about rate cutting cycles. So, Jay Powell just kicked off the rate cutting cycle with a big 50 basis point cut. Let's see what this actually means for us. Generally, the very first thing people want to discuss is why. Why did the Fed cut rates? I've seen some reasons for this, so let's go over some of them and let's see where they take us. First one, growth and inflation have slowed dramatically, which means that monetary policy was too restrictive, and that's why the Federal Reserve cut rates. Rates were cut for the sake of EU, Japan, and China because the world is not doing well. The market itself demands rates be lower, and the Federal Reserve has to acquiesce. The South Park explanation works as well. The headless chicken decides the outcome. But as far as I'm concerned, it really doesn't matter because finding explanations is an exercise in abductive reasoning, right? Abductive reasoning is basically trying to find explanations for a set of outcomes, right? So you infer to the best explanation based on the observations you have and your knowledge base. And generally, what ends up happening is sometimes that your knowledge base isn't large enough for you to come to the correct explanation, or the set of observations are too small and you come to the wrong explanation. Sometimes you come to the right explanation, but this is a form of non-monotonic reasoning, meaning your conclusions are not guaranteed to be correct. Unlike deductive logic, where the conclusion flows perfectly from your premise, right? But for us, in our case, even if we have an explanation and the explanation is correct, where is the added value? Where is the alpha? Let's say the real reason Federal Reserve cut rates is that inflation and growth have slowed dramatically. Well, yeah, we already know that, right? If you just go on the Federal Reserve website, look at a few time series, yeah, we can see that. Oh, Japan's having a hard time. That's why Federal. Yeah, we know that. We know these things. I just don't see where having that explanation helps you, right? What actually matters is this one question. Now that the rate cutting cycle has begun, what does this mean for the S&P 500? We're going to talk about the S&P 500 because the data is the easiest to find for it, like long-term time series. But you can talk about any other asset as well. What does it mean for commodities? What does it mean for real estate? What does it mean for, let's say, some S&P sectors? Like, what does it mean for utilities versus tech? Right, we're going to begin with the S&P 500, and we have two questions that we need to sort of ask. Number one, what happens to the S&P 500 after the first rate cut? Right, so you had this 50 basis point rate cut. What happened to the S&P, let's say 1 year down the road or 6 months down the road? For us, it's always 1 year. The second, more interesting question is what happens to the S&P when you have to invest during rate cutting cycles, right? Because rate cutting cycles, they're not, they can range from months to years, right? It could be a 10-month thing, it could be a 40-month thing, and you have to invest one way or the other. You have to be in the market, right? You can't just say, oh, I'm not going to be in the market, right? So if a client gives you $100 million, you don't tell them that, oh, we're in the middle of a rate cutting cycle, just hold cash or gold or come back in 40 months. That's not how you do business. Our job is to figure out the best possible investment in the environment we're living in. We are now in a rate cutting environment, so we have to figure out what we need to do. Now, the best possible investment might be, cash and gold, maybe. Let's see, right? Let's let some data help us come to some conclusions, right? And more importantly, you have to play the hand that's dealt to you, right? With no tears and no regrets. You can't whine. Oh, there's a rate cutting cycle. We were in a rate hiking cycle, right? And that went on. What were we supposed to do, right? Because when the rate hiking cycle kicked off, what did they say? What did Twitter and what did investment banking research say? Oh, the rate cutting cycle has begun, so we have to now. Oh, it's going to be a bad time for equities. It's going to be terrible time for equities. It's going to be this. It's going to be that. Uh, and they forget to mention that from 1940 all the way to 1980s, it was a rate hike decade. It was 4 decades of interest rates rising, and stocks still did well. And then you had from 1980 to, let's say, 2020, you had 4 decades of interest rates just falling, right? And stocks were still going up. So like over that 80 years, maybe the correlation between these two things is zero. I don't know. Let's look at some data eventually, right? And actually, this was the biggest problem I had. Like I couldn't find data, right? Like you would think that all the energy and ink that's been wasted on the Federal Reserve and what they do, there would at least be some wiki table of historical rate cutting cycles. No, I couldn't find it. I had to estimate it, right? So I had to like go to random places. I had to like pick out specific dates. You would think that there would be there would be numbers attached to like these apparently very important decisions. No, I couldn't find it, but it'll be good enough for us, right? So let's begin with the more interesting question, right? What happens to the S&P during a rate cutting cycle? Because this can go on for 10 months or 12, 20 months or 40 months. So let's break down some data, right? So, so the bottom chart is the federal funds rate, right? And it goes back to, I believe, 1954. And the top chart is the S&P 500. And the parts that are marked red are the rate cutting cycles, right? So we see 2020, we see 2007, 2000, we see the 90s, right? Interest rates were falling then. We see the 80s, we see two places in the 80s, we see the 70s, we see the 60s, and we see a rate cutting cycle even in the 50s. And now just looking at this chart alone should like give you pause, right? You should observe that, okay, yes, the last three rate cutting cycles, right? The S&P like crashed, but there were other times in history when there was a rate cutting cycle and S&P didn't have that bad a time. Like it didn't do a -50 every single percent. It didn't do an economy-wide disaster every single time this happened. This happened the last three times. So if let's look at the chart here, it's more difficult to see because you have the linear scale, right? But you can see that there's some information here that might be useful to us. But then for us, we're interested in 1 year out, right? So 1 year out, our median return is still 12%. Our 99th percentile return is a 51%, and our 1 percentile return is a -40. So if you look at these, right? If you look at this chart, right? This chart here, this is every single sample path of the S&P 500 during a rate cut. Can you pick out a signal? Do you see a signal here? Right? You could be doing a -40, -50. You could be doing a +40, +60. And your median return is a 12%, 1 year out. So where's the signal? Where is the alpha here? Where is this important transition point that would give us an entry or an exit signal? I don't see it. All right, please show it to me. Show me where the signal is for a rate cutting cycle. And like I've been seeing so much material regarding rate cuts and how a disaster is coming. Well, the thing is, like if you actually look at the historical record, the picture is very mixed, right? Yes, the next like 2025 could look like 2007, right? It could look like 2000, but it could also look like the 50s. It could look like the 80s. We don't know, right? So making decisions just because Powell has cut rates by 50 basis points might not be the best thing to do, right? Like I'm always interested in trying to figure out what the data is saying or what a real back test is saying, right? So even in terms of probabilities, right? 1 year out, you have a 73% probability that your profit and loss is going to be greater than zero. There's a 73% chance that if you were to invest in the S&P today, that 1 year from now you'd have a positive return, right? Right? You'd be somewhere at 12%. Your 50th percentile is somewhere around 12%. So like I don't see the short signal here. I don't see the crazy long signal here. This a normal year for the S&P 500 is like an 8 or 9%, right? So this is actually a little better than just a regular average year for the S&P 500, right? In terms of we're more interested in median drawdown, right? Median drawdown during a rate cutting cycle is an 11%. That's just a regular correction, right? But your 1 percentile drawdown is a minus 50. That's like you entering the market at the top of 2000, at the top of 2020, at the top of any of the last cycles, right? But um, what does this mean in terms of our decision making, right? Do we enter the market? Do we exit the market? I don't think this gives you enough information for you to be like, oh yeah, this is a signal. Now, interestingly, there might be a strong signal if you did this exact same exercise, but it was for the real estate market, or it was for tech stocks, or it was for commodities or gold. There might be a very strong signal there. But for the S&P 500, what's being discussed out in the world, I don't see it, and I'm sure, like I hope you don't see it either, right? I hope this is exceptionally clear to everyone, right? That 1 year from today, you're looking at something like a minus 50 to something like a plus 60. And we don't know where we're going to fall, in the grand scheme of things. So this is investing during rate cutting cycle, but I can hear you. I can hear you guys. Oh, well, Omar, that's not what we meant. What will happen? Like the S&P is going to crash from the moment that the rate cutting cycle begins. You're talking about this is the entire rate cutting cycle. Like you could be buying at the top, you could be buying the bottom, like March 2009, or you could be buying somewhere in between. This is not what we mean. We mean from the very first day the rate cutting cycle begins, right? That's the thing that you have to be most concerned with. That's the really scary thing. That's where the 50% crashes. Yeah, all right. You know what? Let's look at that as well. So let's look at, we're going to do the same exercise, but specifically for the very first rate cut, right? So we have 11 data points. This is what I could find. This is what I could estimate, right? So this is 2020 to 2007, 2000, every single rate cut, except it's the very first week of the rate cut, right? And at the bottom chart, you can see the same thing. It's been marked, right? And you should already be worried that, oh, this is not this is not what I meant. This is not what Jim Cramer was telling me. This is not what that random Twitter account that posted a doomer take was telling me. They were telling me that we're looking at a 60% crash and it's guaranteed. Nothing is guaranteed, my friends. Everything that you do is a probability distribution. Every single decision you have to make has an uncertainty attached to it, right? You could be driving in the car today, right? You woke up, you went to work. There's a small probability that you might not make it home, right? We all play in the world of probabilities, right? There's very few times in history, very few times in your life where you'd be like, I am 100% sure, right? And by the way, when you're at one of these critical junctures in your life where it's like, I am 100% sure that this is it, yeah, take the big bet. We never know how that might play out, right? Have the spine to take the big bet. But the rate cutting cycle isn't one of those bets, right? The rate cutting cycle is not one of these places where you're like, I am 100% sure, because we're not. So let's actually look at what actually happened over the last 70 years. Every single time the interest rate was cut from the very first time, right? So 1 year out, now your median return is like a 9.8%, right? So during the rate cutting cycle as a whole, it was 12%. Now it's like um, a 9.8%, right? Your worst case 1 year out is a 23%, which is a lot better than the minus 40, right? Your 1 percentile, your 99th percentile return is a 33%, which is a lot worse than in the case of the full rate cut, like investing during the full rate cut, right? And this is it. This is it. This is every single time every single time the Federal Reserve cut rates and what happened to the S&P 1 year out, right? You have like a plus 20, plus 30 to a minus 20. And it's once again, it's a distribution. It's not like it's a very clear signal. But there is something very interesting in this chart, right? I'm going to point that out because I think that's far more interesting than the final return, right? So if we look at the probabilities here, right? They're very different than the probabilities for the entire rate cutting cycle, right? For basically the first 9 months, right? Even the first 10 months, whether or not the S&P is going to be a positive or a negative return, cumulative return, is like a coin flip, right? It goes from a 30% to a 60%. You're basically you're flipping a coin here. But more importantly, look at your median return, right? Your median return is sort of hovering around a 0% all the way out to July 2025, past July 2025. It's after July 2025 that you can start expecting your median return to become 5% and then 7% and sort of clock out at 9.8% for 1 year out. So this here, what this signal is sort of showing you is that for the next 9 months, expect chop, right? Your median expectation is that the S&P is not going to do very much, right? So if you want to draw a conclusion, I think that's the conclusion to draw, right? That okay, for the next 6 to 9 months, we're expecting the S&P not to do much. That's our baseline expectation. But remember, historically, the individual sample pads, you could be doing a plus 40, right? A plus 30, right? Out to 6 to 9 months, or you could be doing a minus 20, minus 30, 6 to 9 months out, right? So that's your spread. But if we're not expecting the S&P to do big numbers, especially after this first interest rate cut, what exactly should we be doing? That's going to be a topic for the next video, I think, or maybe 2 videos from now. But this is a discussion about the interest rate cuts. Don't let people mislead you. Jesus Christ, just all this data is freely available. Right? This is from the Federal Reserve. Just download it. You can see with your own eyes. You don't like. I think one of the biggest things you can do for yourself, especially when it comes to finance, is basically just ignore Twitter, ignore videos that especially try to like sell you certainty. Right? You'll see some guys. They'll be like, S&P is going to be up 40%. We're going to be in the middle of a golden bull run, right? There'll be other guys that they'll say, no, S&P is going to do a minus 50%. It's the end of the world is coming, right? I think I saw one post. It's like the last 2 times that the Federal Reserve cut interest rates by 50 basis points, S&P crashed by 50%. This is the third time. Just scaring the shit out of people. Right? It's not healthy for anyone involved. It's profitable for those people who are putting this material out because naturally, as human beings, we respond more to fear and I would say even greed than we do to anything else. Right? Like when I say that, listen, everything is sort of like a probability. I can't give you certainty, because I'm not a prophet, right? I'm not an oracle. I can't tell you that 1 year from now your return is going to be this very specific number. People don't like listening to that. People are not interested in that. They are interested in um, uh, certainty, right? Certainty sells, but certainty is not uh, a way to generate profits. Certainty is a way to blow up your trading accounts. It's a way to blow up your life, right? So now that we're in the middle of an interest rate cycle, there's going to be interesting things coming up. Once again, we could be doing something like if you were to ask me, what are the range of outcomes that are available to us? This is the chart. This is the chart that shows you the range of outcomes that are available. Now, if you feel that there is some factor, right? Some your global macro analysis or your technical analysis or your quantitative analysis or your fundamental analysis that is saying that we're more likely to be on the left tail of this distribution a year from now than it is that we're going to be on the right tail of this probability distribution. I would love to hear your thoughts. Let me know, right? But as far as I can tell, in terms of using the rate cut as your signal, it's not as informative as people make it out to be. All the ink and energy that gets wasted on these discussions is a it's damaging not only to your portfolio, it's damaging to your soul. You would be better served uh, reading a book, watching, I don't know, Netflix, uh, going out to the gym, working out. That would be more useful than some of the discussions that we see at every single rate cutting cycle, right? Are we in the middle of a massive crisis? Maybe we are, right? But this rate cut doesn't give you that information, right? It doesn't tell you that. That's something that you have to find from somewhere else. That's another model you have to build. Well, thank you very much, friends. I will be seeing you guys shortly. Have a great day.